OptionChampion.com.
Today is Saturday, December 17th. I'm Rick Adams, and this is Tricks of the Trade.
All data and other information contained throughout this video are for demonstration purposes only and shall not be construed as trading or investment advice or an advertisement for software or other trading applications. Nor shall any part of this presentation be considered a recommendation of securities or other tradable products or related strategies. Trading and investing, whether short or long term, involve risks that may not be suitable for everyone. Any mention of past performance is not an indication nor a guarantee of future results, as volatile market conditions can arise at any time and result in substantial losses. No individual should make any trading or investment decisions without consulting a professional and conducting his or her own research.
Welcome to the final episode of Tricks of the Trade for the year 2022. Two major events took place this week: the CPI print for the month of November and the Federal Reserve decision on interest rates. There were trades made ahead of each one. Take a look. This is the trade that was made ahead of Tuesday morning's CPI print, the Consumer Price Index, also known as the inflation print. And because the number was coming out Tuesday morning before the market opened, I needed to get the trade on Monday afternoon as the market was closing, so that when Tuesday morning came along and the CPI print came out, I would already have a position on and I would be ready for the market's reaction to the CPI print. And this was a trade in SPY. As the market was closing on Monday, SPY was priced at $398.95. And because there was no way of knowing how the market was going to react to the CPI print, whether we were going to have a huge rally or a major sell-off, I put on a 398 straddle in SPY, expiring on December 16th. So this is in the regular monthly cycle during the week of expiration. And I bought a 398 call for $6.99 and a 398 put for $7.01. So the price paid was pretty close together, about the same amount of risk on each side. And I started with a one lot. The idea here was to start small and either add to the position as needed, whether it was adding to the whole straddle or adding to one side or the other of the straddle, or taking the whole straddle off if it were profitable. That was the trading plan for Tuesday. Well, Tuesday morning came along and the CPI number came out. Month over month, CPI showed an increase of 0.1%. The estimate was 0.3%, and the previous month's reading was 0.4%. So the 0.1% increase was better than expected and better than the previous month's reading. Year over year, CPI showed an increase of 7.1%. The estimate was 7.3%. And the previous reading was 7.7%. So all around, it was a good report, and the markets responded positively to that. There was a huge rally. The Dow was up more than 800 points. The S&P was up over 100, and that was good for the call side of the straddle. I didn't have to do anything to the call side of the straddle. You see down here in the lower left corner of the chart where the crosshair is, this is roughly where the 398 call closed on Monday. And up here, you see where the horizontal line is. This is roughly where it opened on Tuesday. That was more than a $5 pop to the upside. So I just took the 398 call off for a $514 profit. The put side of the straddle, however, needed to be managed. Because we were in the midst of a huge rally, put option prices were getting crushed. So I needed to take action and manage the remaining side of the straddle that I had, the 398 put. I needed to manage that so that I wouldn't have a loss. I paid $7.01. You see the upper left corner of the chart here where the crosshair is. This is roughly where it closed on Monday. And down here, if you follow the horizontal line, that's where it opened on Tuesday. I paid $7.01 and it was marking at $1.70. That's a big drop to the downside. So I averaged down. I'm reading straight off of my trading journal here. I added 5 lots at $1.70, giving me a total of 6 lots, bringing my average price down from $7.01 to $2.59. So a little bit closer to the market price at around $1.70, but still pretty far apart. It was marking at $1.70. My average was now $2.59. So there was still a little ways to go. The market continued to rally. Put option prices continued to slip. So I cut the position in half right in this zone here on the chart. I cut the position in half. I sold 3 lots out of the 6 that I had at $1.70. So I'm holding on to 3 lots now, reducing my position size from 6 down to 3. And I took a $327 loss on that reduction. Well, thankfully, the market then started to sell off from their highs, and that was pushing put option prices up. So right around here in this area, I added 2 lots at $1.78, giving me a total of 5, bringing my average price down from $2.59 to $2.27. Market sold off a little bit more off their highs. And you can see on these candles here, prices are starting to move up on the put side. I added 5 lots at $2.30. So we've now had a big move to the upside. When I was starting to add, the 398 put was priced at around $1.70. And now at this point, it's at $2.30. So this is going in my favor. I added 5 lots at $2.30. I now had a total of 10 lots at an average price of $2.29. Markets continued to sell off from their highs a little bit more. And right about there, I sold all 10 lots at $2.70 for a $410 profit. Add all those together, the $514 profit on the call side of the straddle, the $327 loss on the cost basis reduction on the put side, and the $410 profit on the rebound, that gave me a total profit of $597 on the straddle. And you can see here the realized P&L column. So $77 on the put side, $513 on the call side. That's $590 after commission. So all in all, the 398 straddle worked out. Moving on to Wednesday, another big day, FOMC, the Federal Reserve decision on interest rates. Fed Chairman Jay Powell was expected to release a statement at 1 o'clock Central Time and speak at 1:30. And because he was speaking later on in the day while the markets were open, I did not have to put a position on the day before like I did with the trade on the CPI print, but I chose to put a trade on the day before anyway in the event that I could take the position off early, meaning before he spoke, and take profits. As of market close on Tuesday, SPY was priced at $401.97. I put on a 401 straddle, so the 401 strike was near the underlying price of $401.97. I bought the 401 call for $5 even, and I bought the 401 put for $5.26. In the upper left corner of the screen here, we can see the activity in SPY over the course of the trading day. And the markets held on to a pretty strong rally throughout the morning. And as we saw in the earlier charts with the trade on the CPI print, as the markets were rallying, put option prices got crushed. Same thing happened here. Markets were rallying, put option prices were getting crushed. So that meant I needed to manage the put side of the straddle. So I added 4 lots at $4.68, giving me a total of 5 lots and bringing my average price down on the put side of the straddle from $5.26 to $4.80. I increased my position size on a price dip in order to reduce my average price on the put side of the straddle. Markets continue to rally. Put option prices slipped even further. And in order to manage my loss, I reduced my position size. I sold 4 out of the 5 lots that I had at $4.40, leaving 1 lot open. And on that reduction, I took a loss of $158.40. I reduced my position size so the loss wouldn't get out of control. Markets rallied even more. Put option prices slipped even further, and I added 9 lots at $4.10, giving me a total of 10 lots and reducing my average price even more from $4.80 to $4.17. I increased my position size on another price dip to bring my average price down even more. And as I said a moment ago, markets held on to a rally throughout the morning. And as we got closer to 1 o'clock, I'm going to move the crosshair over to SPY on the left corner here, the upper left corner. As we got closer to 1 o'clock, when we were expecting the statement from the Federal Reserve, there was no way of knowing how the market was going to react to that. Same thing with the CPI print. We don't know what direction the market's going to go. It can continue to soar higher and hit new session highs, or it could sell off sharply. So I reduced my position size in order to take some risk off the table. I sold 5 out of the 10 lots that I had at $3.80. And on that size reduction, I took a loss of $184.80. So far, up to this point, I've incurred a loss of $343.20. 1 o'clock comes along, and the statement is out. Federal Reserve increasing interest rates by 50 basis points, pushing the Fed funds rate up to 4.5%. And Jay Powell said ongoing increases will be appropriate to return inflation to 2% over time. Markets did not like that, apparently, because they sold off almost instantly. And we can see that here with the big red candle. This is the initial reaction on the statement from the Federal Reserve. Markets were in negative territory, and that was great for the put side of my straddle. So I sold the remaining 5 lots that I had at $5 even for a profit of $415.20. Add all those together, the loss of $158.40, the loss of $184.80, and the gain of $415.20. The net result was a $72 profit on the put side of the straddle. So that meant, now that markets were selling off, the call side of the straddle needed to be managed. And thankfully, the sell-off was cooling down. Markets were rebounding off their session lows. And on the rebound, I added 9 lots to my 401 call at $3.97, giving me a total of 10 lots and reducing my average price on the call from $5 even to $4.07. So I reduced my average price by 93 cents. Markets continued to rebound, and I sold the 10 lots at $4.10 for a whopping profit of $27. Add that to the $72 profit from the put side, and I netted a profit of $99 before commission. After commission, it was $72, and we can see that here in the realized P&L column. $59 in profit on the put side, $13 in profit on the call side. All of that after commission added together, $72 profit on the straddle. Any gain is a good gain. As I mentioned in the intro, this is the final episode of Tricks of the Trade for 2022 as we head into Christmas and the new year. And I wish all of you a very Merry Christmas and a Happy New Year. That's it for this episode of Tricks of the Trade. I'm Rick Adams. Thank you very much for watching. See you in 2023.